Perfect.
All right, everyone, welcome back. And just a quick reminder, if you have any questions, do feel free to type those in the questions box. We'll get those answered time permitting at the end of this session. We're delighted to welcome the founder of the Options Lady and financial advisor with Coastwise Capital Group, Laurie Itkin. In this session, Laurie will explain why writing covered calls is one of the best solutions for boosting yields with the added benefit of reducing risks that come with equity investing. Laurie, thank you so much for being here.
Oh, thanks for having me, Mark. All right, well, let's get started, everyone. First, I want to thank the Money Show. I think it's a great place where you can get lots of free information about all types of investing. And I'm here today to discuss one of my favorite investing strategies, and that's covered calls. And this, we have a half an hour today. I'm going to try to get through my slides in 25 minutes to save room for about 5 minutes of questions at the end. And I think this session is appropriate for you if you've have some stock or ETF trading experience, but don't know much about options, and also this might be good for people who have tried covered calls but still don't feel very confident in their abilities. Let's see, I'm not able to move my slides. Now I am. Okay, great. Now fine. Okay, thank you. So a little bit about me. As Mark said, I'm a financial advisor and money manager at Coastwise Capital Group. We're a boutique money management firm in La Jolla, California, outside of San Diego. And, you know, we do what most other money managers do in terms of building diversified portfolios, but we also have a specialty in writing covered calls as an overlay on stocks and ETFs. But I'm also the founder of the Options Lady, which I set up to coach people who don't have enough assets for us to manage. So this might be people with smaller account sizes, or just do-it-yourself investors that don't want to hire a money manager but just want to have the coaching on how to do the strategies. And then finally, we're really proud to be the author of an Amazon bestseller in 3 categories, both in options, stocks, and investing, introduction to investing, and that's Every Woman Should Know Her Options. All right, first of all, just a disclaimer that anything I talk about here, I am going to show charts and options chains on various stocks, and it's absolutely not a recommendation to buy or sell stocks or options. I'm simply using these stocks as an example so you can actually see how the covered calls work. All right, so there are really 3 ways to profit from stock investing, and a lot of us really only think about the first 2 ways. And obviously, we all know about capital appreciation. You want to buy a stock at a price and hopefully in the future sell it at a higher price. We also know that one strategy is simply to get stocks that may or may not have much capital appreciation over time, but they are constant dividend payers. So you can actually make money from dividends whether or not the stock goes up much at all. Obviously, we ideally want stocks that go up over time and pay dividends. But the third way to profit from a stock is one that people don't know about, and that's call option premium. And what we do at Coastwise, our philosophy is we try to build portfolios of stocks and ETFs where the client does have the prospect of both capital appreciation, the dividend capture, and we sell call options. And the rule of thumb is that, again, this doesn't apply in every case, but it's simply a target. If you own a stock that pays a 2.5% dividend yield, for instance, you can usually, with selling out of the money call options, your target should be from that same stock to generate not just a 2.5% yield, but you can often generate 2 to 3 times that yield with option premium. And let me show you how that works. So the strategy is really you're renting out your stock by writing covered calls. You have this asset and you're trying to generate income for it. So when you're doing this, you're basically, let's say you own stock. You're agreeing, you're going to get paid now by selling a call option to agree to sell your stock at a specific price in the future. So if my stock's at 100 and I agree to sell it at 105 in the future, I'm going to get paid something today. That's the option premium. And you typically need 100 shares of stock or ETF, and you combine it with the sale of a call option. That's what a covered call is. And you can either enter this from a cash position or by selling calls on stock you already own. So for instance, let's say you have a concentrated stock position. A lot of people leave jobs, maybe they had restricted stock units or options, and now they own, most of their wealth is in one stock. A great way, you don't want to sell it necessarily because you might have embedded long-term capital gains, but what you can do is sell call options on it. You're going to pay tax on the call option premium if it's a taxable account, obviously not if it's an IRA, but you're going to be generating income, which not only generates income, but it also serves to cushion if your stocks go down in value somewhat. What people don't realize is that a lot of people think options are risky and complicated. This strategy is actually more conservative than just buying and holding stock. Okay, because of that income generation, it creates some of a cushion. Just like if you hold a dividend-paying stock and the stock goes down a tiny bit, you may actually be better off because the dividend income is higher than that. A lot of people like this, especially retirees who are looking for yield. Bonds aren't paying much, so it's the ability to generate regular income that you can either spend or let compound in your account. You make money when the underlying stock is going up, stays flat, or even declines a bit. That's a great benefit. And again, we limit risk in case the stock price falls. And it's such a conservative strategy that it can be used in your IRA. We have lots of clients that use this in any type of IRA. There's no free lunch, and there is a downside. The downside is you are agreeing to place a cap on the potential stock appreciation of the stock because you're agreeing to sell it at a higher price in the future, and you may end up having to sell it at that higher price. And as I said, this is a great strategy for concentrated stock positions. Now we're going to go into a little more detail how this works. Let's say you could write a covered call on a house. I like to use this example. Many covered call educators use a similar example. Let's say you bought the home for $1 million. 6 months later, it's assessed at $1.1 million. That's actually, a 10% gain in a hot market in 6 months happens. Okay, you're already 10% up. Now you're asked if you would commit to sell this house for $1.2 million 6 months from now in exchange for getting $30,000 today. So the strike price in this case is $1.2 million, and the call option premium you receive is the $30,000. So let's think about this. If you end up selling the house to this potential buyer 6 months from now, which would be 12 months after you bought the home, your annual return is you've made 20% capital appreciation on the home. You bought it for $1 million. You're selling it at $1.2 million, but you got that $30,000 in option premium. So your annual return if you sold is 23%. Annual return if not sold. So let's say the home doesn't reach $1.2 million or higher. Your annual return, if not sold, let's say it's appraised at $1.15 million. Well, your annual return is 18%, not 15%, because again, you got that $30,000 in option premium. If the home is appraised at $1 million, you bought it for $1 million, you've made a 3% gain because of that option premium. And finally, because of the option premium, that home could go down to $970,000 in value, and you are whole. That's your break even. The downside is if the home is appraised at more than 1.23 million, you've sold it for 1.2 million, you got the 30,000 in option premium, but if that house blew through the roof and had a 30% gain, your max gain is 23%. So that's the downside. Again, this is more conservative because you're always giving up potential upside in exchange for immediate income today. So let's put this in the stock scenario. Pretend this house was not a house but was a $100 stock. You bought 100 shares for $100 a share. That's a $10,000 investment. 6 months later, those shares are worth $11,000. You're now asked if you would commit to sell those shares for $12,000 in exchange for $300 today. This happens all the time in the stock market. My 100 shares at $100 a share, I can agree to sell them at at $12,000 for all of them and get the call option premium today. Your annual return if you sell the stock, which you have to if it now the value goes up more than 12,000. So if the stock goes up more than 20%, you have to sell it. But if the stock doesn't reach that strike price, you've actually made an 18% gain. And if the stock trades at 100, you bought it at 100, you've made a 3% gain. Had you not sold the call option, you'd have a 0% gain. And finally, your break-even point is even if those shares that are $100 a share fall to 97 a share, you've broken even because of the call option premium. Again, the downside to the strategy is if the stock price rises above $123 a share. Let's say it goes up to $130 a share. You might kick yourself by saying, why did I agree to sell it at $120 a share when I would have made more money in that case just holding the stock and selling it at $130? Well, that's again the choice you make. Again, I would often rather to have some guaranteed income today and cap my upside appreciation. So if the stock price falls below 97 a share, so imagine you have a stock that's fallen 3%, you are still better off than the investor who didn't hedge, because the investor who simply bought 100 shares at 100 has now lost $3 a share. Now, again, people often say options are risky. Well, yes, the covered call strategy can be risky, but the risk is not in the call option that you're selling. It's the underlying stock or ETF that you're investing in. So if the stock or the ETF falls a lot, yes, you've still lost money, but it's the risk you already hold as a stock investor. Because if the stock falls a lot, you are still better off than the guy who just bought and held the stock and didn't sell a call option. Okay, our covered call is right for you. I have two ladies lounging at the beach here. Covered calls are not right for you if you want a passive investment strategy. This is not the strategy where you go in and you simply rebalance your portfolio once a year. You must be willing to take the time to think and take action, because if you sell a call option that has an expiration a month or 2 months from now, there are decisions you have to make. And that's why, a lot of people hire us at Coastwise because they want to outsource. They like the strategy and they want to outsource it. Alternatively, if you're somebody that is managing your stock portfolio on a regular basis, this would just be something you need to learn and integrate in as part of your strategy. All right, so let's get into some technical detail here. And I am going very fast simply because we have not much time in this. So take a look at this. This was CRM, Salesforce. I took this picture a long time ago. It might even be 2 years old now. But it's a 6-month chart. Can you imagine if you bought the stock at the left side of the chart and sold it at the right side of the chart, basically you would have bought, you bought and hold this stock. After 6 months, what's your return? Your return is zero because this thing has gone up and down and sideways and up and down, and at the end of 6 months, your capital has not made you any money, right? I like my capital to be working for me, but I look at a picture like this with all this volatility, ups and downs, and I think, oh, this would have been a great candidate for a covered call. All right, now let's get into some technicals of what an option chain looks like. If you're not familiar with options at all, I'm using TD Ameritrade's Trade Architect platform, and I like TD Ameritrade. They have really 3 platforms that you can use. And in fact, in my book, I use this platform as for illustrations. So I actually took this screenshot 70 days before July 17th because I was using this for another presentation. So just think, I'm looking at strike prices 70 days out, and you can see that this is an option chain for Qualcomm, and what Qualcomm at this time is trading at 69.41. So that's what the shares were worth. Now, if I were to agree to sell my stock at a higher price in the future, this is how I would generate the call premium. So it's trading at 69. So I could say to myself, you know what? I already own 100 shares of this. I would be happy to sell my stock at $72.50 70 days from now, because that would be a capital appreciation, right? I would be selling it for $72.50, and either I bought it at $69.41 or I bought it at a lower price. So if I agree to sell it at $72.50, I bring in $76 in premium. If instead I agree to sell it at a price slightly higher than what it's trading now, I bring in $161 over 7 days or 70 days. So, this is not a huge get rich, like buying a call option where you can triple your money quickly. No, this is incremental income. Qualcomm already pays about a 2% dividend, slightly higher, and I'm simply generating more income. And this is why you have to decide what expiration, how far out, and what strike price to pick. Okay, Facebook. Facebook doesn't pay a dividend, and so covered calls is a great way to yield income from a non-dividend paying stock. So in this case, Facebook was trading at $77.89 a share, and I can go to the option chain. I'm going to get more premium because this is a more volatile stock. It has a higher beta, and I could agree to sell it in the future for $80 and bring in $191. And I could agree to sell it at about what it's trading at now and bring in $300. So the idea is you're going to continue to bring in premium every month, every 2 months, every 3 months, depending how far out. Now, of course, the stock could be sold at that price, and then you no longer have the stock. You sold it at a gain and you made option premium. Of course, the stock could have fallen. And if the stock falls, in that case, you continue to hold the stock and you get to keep that premium. So it's a cushion. Here's one more screen I want to show. This is if you are entering into a covered call position from cash. I could enter the 70 covered call. So basically, it's trading at 69.40. This is Qualcomm again. And instead of just buying 100 shares at 69.40, I can enter into the covered call. And it tells me right now that if I agree to sell it at 70, my max profit is $220 on the trade. But here's my break even. Look at this. The break even is $67.80 per share. and I bought it at 69.40. So I'm actually buying the stock, and when I write the call option at the same time, it lowers my cost basis. So frankly, I'm getting to, in a way you could think of it, I'm getting to buy this stock on sale. Instead of paying 69.40 a share, I end up paying 67.80 a share. And if you go out higher, you're going to have a smaller option premium, but ability for the stock to be held by you before getting sold at a higher price. So you have to make these decisions. Now here's a great software that I use. It's called Born to Sell, and this just shows you really easily, if you subscribe to this. I was looking at Facebook, looking at an October expiration, and this is telling me that if the stock is at 77.85, if when the second line down, if I choose to buy it and sell and agree to sell it at 80, my annual return if the stock stays flat is this number. All right. You can see the annual return is higher if I choose an at-the-money strike price. If I just decide that I'll sell it, instead of I want to have more room for it to grow, so I could sell the 85, I'm going to get less option premium. So you've all these choices to make, but this shows you very quickly of all the strike prices I can look at. I can change the month here, the expiration. I can do all these filters. Now, here's a screenshot I took on May 4th for Apple, and I was looking at the July expiration. This filter shows me the different strike prices, the annual return I'd make if the stock stays flat. It doesn't go up or down, but it also shows me if the stock's called away, what I make on an annualized basis. So just a good way to look at all your different scenarios of strike price. And then the Born to Sell, you can just search, you can search for candidates with all these different tabs. So issues to consider when you're trying to become a covered call master, a master of covered call writing. You have to figure out what expiration you want. And if you are going to be writing weekly or monthly calls, you're going to be paying commissions. You don't want to be paying tons of commissions, so you need to balance the commission, the time that you can put into this, whether or not you can capture the dividend. Here, one of the complications is that if you bought a stock like an AT&T or Verizon, for instance, with a very high dividend yield, I think AT&T is over 5% and Verizon might be close to 5%. If your stock gets called away because you agreed to sell it at a certain price, you may very well end up selling it right before the dividend's paid out, and that's a bummer. Another issue, do you hold a covered call through an earnings announcement or not? When you sell a call right before a stock is going into their earnings announcement, you generally get high premium because often every 3 months when there's an earnings announcement, if it surprises Wall Street, disappoints Wall Street, exceeds Wall Street's expectations, you can have a high or low, a big jump in the price, either high or low. What we like to do is we like to sell call options on strength. So we may buy a stock or an ETF when we think it's trading low in its range, we think it's undervalued, and if there is a positive earnings announcement or another event that pushes the stock price higher, let's say the stock now is up 5% after we bought it, we may then sell a call option to sell it at maybe another 5% higher, because the call option premium is going to be pretty rich at that time. So that's a strategy we like to use. You can use ETFs. A lot of ETFs that are liquid, high trading volume, have tight bid-ask spreads. You can write covered calls on them, but the trade-off is that because ETFs are inherently diversified, they own so many underlying stocks that they are, you're typically going to get less option premium. And these are just some examples. There are many more ETFs, but some of the ETFs that we've often written call options against in the past. The U.S. obviously the SPY. You can get really anything you want. IWM is the Russell Small Cap. QQQs are tech. XLV is the healthcare companies. XL Financials. These are all have very good. You're not paying a big difference between the bid and the ask. The spread isn't very high, so more money is going to you and not the market maker. Emerging markets, a lot of them are good for options trading. Developed European, I've listed some, and then commodities, especially like USO's oil, GLD's gold, GDX are the gold miners. Those have a high option premium because they've been very volatile. Gold has basically been declining in value over the past several years as we've had the bull market, and we all know about the story about oil prices. So these would be a slightly more speculative play. Tax treatment of covered calls. I'm going to actually skip over this because we're running out of time, but frankly, there are a lot of things to consider, and that's why most people just prefer to trade covered calls in their IRA since they don't have to track all this. That's what I just said here. And then you've got issues like managing your existing positions. What do you do if you had sold out of the money call option, but the stock price now is higher than the strike price, right? So, what do you do? How do you manage that? Do you just let your stock get called away? Do you sell the stock early and buy back the call option? Lots of things. What do you do if the stock price drops somewhat, but you still want to hold the stock? You've got a short call hanging on that. What do you do when the stock price drops significantly and you no longer want to hold the stock? Really same issues that you would consider if you were just holding stock anyway. But you need to just figure out, can that cash be allocated better elsewhere? And then why don't more financial advisors write covered calls for their clients? Frankly, it's time. I mean, as a financial advisor, many of us charge an assets under management fee, and this is much more time intensive than throwing people into a cookie cutter portfolio of stocks or ETFs or, gosh, high fee mutual funds. And a lot of people who are financial advisors don't have the expertise, and our fee might be slightly higher than what you'd get by going to a financial advisor at Wells Fargo or Chase or something, because they're not doing these strategies. But we need to have a slightly higher fee because it's so time intensive. But it's really great for concentrated stock positions. I have a lot of clients that have concentrated stock positions, and they simply want the covered call overlay on their portfolio to hedge. Born to Sell, if you are interested in this, it's not my product, it's a different product, but because every time I do a MoneyShow presentation, Mike Scanlon likes to give an offer to options lady people, so you could sign up for a free trial. And just enter options lady at the top. It says that the trial expires May 31st, but we're in June. He's extended it a year, and you'll basically get some extra bonus months. But again, it's a 2-week free trial. I encourage you to try it. You're going to go to borntosell.com, options lady, where the arrow is. And ways to work with me. As I talked about, I'm a financial advisor at Coastwise Capital Group. The account minimum for where we will do covered call overlay on is $200,000. Our fees range from 1% to 1.5%. Very large accounts, it's a lower fee. And we construct a diversified portfolio of stocks and or ETFs with a covered call overlay. Portfolio is reviewed at least once a month, and options positions actively managed, and we also do tax loss harvesting for non-retirement accounts. And then if that's not of interest to you, I have a lot of clients who do my coaching. I use screen sharing, so I have clients all over the country. It's $450 for 3 one-hour sessions. You choose your own stocks and ETFs, and I'm simply helping you analyze what happens if you write different strike prices, different expirations, sort of like what we did today, but specific on your portfolio. Um, you're just not getting investment recommendations from me. And finally, how you can reach me. Well, first of all, if you just go to theoptionslady.com, that's the easy way to remember me. You can contact me through the website. Here's my contact information. Encourage you, if you have any women in your lives who may not be, who just, they're really not into the stock market or they feel overwhelmed, my book is a really good introduction to investing. And then again, Born to Sell is offering a free month or more with your trial subscription if you enter Options Lady in the How Did You Hear About Us section. So I know I went this through very quickly. In fact, we are out of time, but Mark, could we take just a couple of questions if there are any?
Sure. We didn't have any questions pop in during the presentation, folks, but we have a minute or so. If anyone out there has any questions, real quick, just type those in the question field and we'll try to get those answered for you.
And I just condensed about a 90-minute session in 30 minutes, so I know I talked very quickly and I apologize for that.
Oh, that's all right. It's a great presentation.
All right, well, if there are no questions, feel free to contact me one-on-one. Just go to theoptionslady.com and I'll respond usually within 48 hours.
All right. I did have one just pop in.
Okay.
Laurie, how far out in time do you go?
Yeah, it really depends on the size of the portfolio, taking into account commissions. For the clients where I actively manage the portfolios, I typically go 1 to 3 months out. For my own personal trading, I go a month out. And in my coaching program, since we usually spread one session over once a month over 3 months, when I'm coaching clients, I like to have them choose a strike price that's going to expire somewhere between 1 and 2 months. So simply that once it's close to expiration, we can actually have a very helpful session about managing the option position. What do you do? Do you roll it into a future month? Do you let the stock get called away? What happens if the stock tanks? What do you do with the option? So that type of thing. But most some options traders will do weekly call options on Apple. I mean, it's really there's just pros and cons for both. The longer you go out, the more premium you get. However, because of the logarithmic formula of options and time decay, if you go out 2 months at the same strike price, you will not get double the premium that you got for 1 month. So it's a decaying premium that you're getting.
All right, excellent. Thanks so much for that. I had a question pop in here from Terry that I can answer. She was asking if this webinar will be recorded. Yes, Terry, you will receive a link to this webinar. You'll be able to go back and view anything that you missed. But with that said, Laurie, I want to say thank you very much for being here, and it was a great presentation today.
Thank you very much, and I'm glad this will be just for, I know anybody who registered will be able to watch this later on.
Yes, correct. They'll receive a link and they'll be able to watch it in the e-show, so they'll be able to go back and review it.
Wonderful, wonderful, great. All right, well, thank you so much, Mark, and I want to thank the Money Show and for everyone who attended today. Looking forward to hearing from you folks. Okay.
All right, have a great day, Laurie.
Thank you.
Bye.